So, obviously this panel is near and dear to our hearts and probably the most important panel of the day. Next time we'll do it in the morning. We have everybody's attention. But I think what people don't really realize, and we spend a lot of time talking about how quickly the industry is growing, right? I talked about earlier this morning that we saw 4,800 companies come on and raise under Title II. Well, there's only 6,000 publicly traded companies in the US. So 4,800 is a lot of securities to track. Going over the marketplace lending side, we're talking about hundreds of thousands of loan listings, whole loans, securitizations. So all of a sudden in the past year, the world has been flooded with a lot of securities to track and maintain, along with a lot of data. So what we want to talk about today is really sort of communicate and let people understand that there are grown-ups who have come to the party and who are building the necessary sort of data and technology infrastructure that's required and that's always been available for any new asset class that's entered Wall Street. There are always providers like Thomson Reuters, for example, who come in and build the infrastructure. But in our world, it's moved so quickly that unless you're as smart as we are, you weren't ahead of the curve in thinking about what to build.
Hi, I'm Steve Ferrando. I'm actually the president of CrowdClear. Everybody seems to try and promote me into the CEO slot, but that's okay. It's because I'm usually up here being the public face of CrowdClear. We're a FINRA registered broker-dealer. We work with funding portals to handle the regulatory and compliance aspects of doing a Title II raise. We provide issue due diligence, investor onboarding, handling the flow of funds between the investors and the issuers. We've got a number of portal partners that we're live with right now and looking to expand with a couple of other interesting strategic relationships in the next 3 to 6 months.
Hi, my name is Matthew Burton. I'm the co-founder and CEO of Orchard. We're a technology platform that helps institutional investors connect with marketplace lenders. And so that's everything from back office to analytics to credit models to order execution systems. We really touch almost every part of the ecosystem that exists here. We also do a lot of work with custodians, fund admins, leverage providers, and really view ourselves as kind of the center of all the data in the space.
Scott Purcell, CEO, founder of FundAmerica. We are a tools, technology, and compliance provider, the crowdfunding portals, and other 506B, 504, Reg A, whatever, any kind of securities offering, they are our customers. We give them plug-and-play APIs, widgets, applications, so that they can efficiently build into their front-end platforms and handle escrow services, state blue sky compliance, electronic document signatures, anti-money laundering and Patriot Act background checks, and a variety of other services.
Hi, I'm Mike Armstrong, CMO of ZestFinance. We are a startup financial technology company that is transforming credit underwriting through the use of big data analysis and machine learning algorithms. In short, we deploy Google-style math to build much more powerful credit decisioning tools. When we originally started the company, we started out to solve the very hard problem of helping people who don't have access to credit.
Yeah, my name is Rohit, and I'm the co-founder and CEO of Biz2Credit. We're a 6-year-old company, small business credit marketplace. And when we started the company, we didn't have a lot of these third-party guys, so we actually built a lot of the data pipelines ourselves, and while doing that, we actually got a lot of insight into what happens in small business life cycle, the cash flow analysis, and initially we crowdsourced a lot of underwriting models from different lenders, including banks and non-banks. So what we have built is a pretty robust platform, which includes both the banking as well as the institutional platform. So we do a lot of loans on institutional platform, which get then bought by banks after a certain period of time. And we see a lot of value in data, both for institutions, consumers, which are small business owners, as well as the banks.
Great, thank you. And I guess how many are familiar with what Crowdnetic does? I guess we just assume. Okay, good, then I won't talk about it. talk about it after I've had a few drinks. It gets more exciting. So why don't we start with Rohit and Mike and follow on sort of your big data and that theme. I guess first, though, can you kind of talk about what problems you guys see today in how old school underwriting happens and what is not being utilized with respect to big data? And then we can kind of talk a little bit about how you're applying big data processes to fix those problems. But if you could just talk a little bit about, why is it broken now?
Yeah. Okay. So we work with a lot of banks, and as I was saying in my earlier presentation, none of the banks even today even have an online digital application. So forget using any big data for anything else. So what we find, which is very challenging when you're working on the banking side, is that these guys are still so used to paper stuff. So let's say a customer comes in and they get a digital application through our platform. The banks still need a site visit with the paper tax returns for last 3 years, and then they want to take it back, do the manual underwriting. Their LOS systems are mainframe based, they're very antiquated. And then their whole analysis, the way they are doing it is so, I would say, at least 5 years back, and they haven't really adjusted their credit models even today on how the some of the sectors are coming back. I give example of transportation, logistics, hotels, motels. So most of the banks are still considering those as a very high risk industries, which is not the case anymore. So I think that's a big challenge that we are still seeing in the banking space. Institutional side, yes, they don't have a history or a legacy, so they're using more and more, I would say, automation. They're using big data more smartly. So I think that's a big innovation which banks will have to adapt, sooner than later, because otherwise their cost of doing business. Today, we have a lot of banks on our platform, and they come and tell us that doing a loan or even looking at a loan where the request is less than $500,000 doesn't make any sense for them. So I think that's a huge challenge and an opportunity also, actually.
Yeah, absolutely. So Mike, tell us what was in your pitch deck when you raised $20 million for ZestFinance. What's the problem?
The challenges that big data, the challenges in underwriting that big data can solve are pretty clear. So the huge swaths of Americans, they don't have access to any credit because it's really difficult to underwrite loans when there's no credit history. There's other Americans that have credit, but they are mispriced for the real risk that they present. And that oftentimes is due to missing or inaccurate data. And sometimes the models that are used are just too simplistic. So it was reported recently that Ben Bernanke was declined for a mortgage. And the reason for that is because he went from having stable income to having less stable but massive income with book deals and the such. So I think we'd all agree that it's mildly humorous because it's so interesting. And so we believe strongly, and we've worked really hard on our technologies that have really proven this, that big data machine learning algorithms, the Google math, does a much better job of maximizing the signal value in any data, whether or not there's missing data elements, where in the past traditional underwriting systems would just sort of throw those out, or if there's inaccurate data, which intuitively creates underwriting challenges, but those challenges are what the big data, machine learning, Google-style math has been able to solve for. And so, we consume massive amounts of data, and we are able to find the most signal value in all of that data. And when we bring that to bear in our underwriting models, we build better underwriting decisioning tools, which is the key to unlock the problem, to make sure that Americans have access to the credit they deserve, and they have access at the fair price against their risk profile.
So what do you think is the barrier to, or the sort of why banks are resisting utilizing the ideas and processes that you guys have figured out? Is it legacy issues there, legacy technology, legacy processes, and it's just you're an innovator and they just become a client of yours? I mean, I guess talk to us about sort of how you go beyond obviously just operating in the marketplace lending space, but does your technology also then go and revolutionize and upgrade retail banking?
Yep. So I think, so there are two challenges, and I will share some stats here. So most of the banks, and we work with out of the top 10, at least 4 banks right now, and the stats are staggering. 40% attrition rate at their branch network every year. Most of them have chief credit officers who are in their late 60s, early 70s. There's no retirement age for them. They don't even know, or they're not even comfortable using say emails. So forget any other technology. There is a 47%, if anybody has applied for mortgages, there's a 45060 form. There's a 47% rejection rate because of fat finger error today in banks, while they are trying to check the IRS data from the customers. Because what banks do a very bad job is that they are not trying to say to the customers that make it more self-service. If they make it more self-service, and that's what we are working with at least 3 big banks right now, where these guys have white labeled our platform. And one of the key learnings for us has been that we see that after 7 p.m. every night and over weekends, more small business owners actually complete their loan applications. So we take the same loan application online, we take them to 45060 digitally, we ask them to sync their bank accounts, we ask them the authorization to pull their personal credit, we will go and pull their LexisNexis reports. We do everything what a bank has to do, create PFS, create all the cash flow analysis and everything. And we are finding out more and more people are doing it when they like to do it on their own, and actually that reduces the errors. And if you can communicate to them, the second biggest challenge is that with such a high attrition rate, the branches are pretty useless today. So when they're trying to get the small business loans or even consumer loans or personal loans, most of the guys don't know what they're doing. They're not motivated.
Right.
And the whole document collection process is so challenging today for banks because it's still manual. So by helping them first to digitize it, making their own staff more intelligent. We have 40 loan specialists in our company, and we are handling over $600 million in lending. We handle more lending a year than some of the top banks are doing it. And I'm talking more than half of that volume is a bank lending volume.
Yep.
So we are doing same things out there. So I think big data. The other key thing is big data has become very fashionable, but a lot of bank underwriting, if you see SBI underwriting, and there is a very good stat over last 13 years, the default rate is only 4.8%. SBI was the only federal agency which didn't take a bailout from the government during the recession. So I think some of the underwriting, the way they are doing it or the methodologies are not bad. They're actually pretty robust, but not using the technology, not using the big data, not using the other data elements, is what is defeating that. And that is actually leading to I would say, inferior underwriting than just the underwriting standards itself, or the way that they're looking at the ratios or what they need to look at is pretty robust. But trying to do that is so time consuming and so labor intensive today
Right.
that that's a problem.
Right. So those reasons, and Mike would definitely want you to chime in a minute, because I want to point this over to Matt. But all those things that you sort of just named is also one of the reasons why we're also seeing trends in traditional lenders partnering in the marketplace marketplace lending world. And Matt, I know you've had some pretty recent experience around that. You want to speak to that, and then would like to hear Mike's thoughts again on sort of revolutionizing retail banks.
Yeah, so I mean, I'll start out by just describing the process really briefly to everyone. When you actually buy loans from a lending club or a Prosper or a funding circle, what you're doing is you're signing a loan purchase agreement and you're agreeing to buy whole loans. And it's basically a pre-order. They're listing it, and then you have the ability to re-underwrite it and then select it and buy it if you choose so. What actually goes into that is a large amount of process that we deal with on a daily basis. And we collect over 400 gigabytes of data from all of those, whether it passed the model, whether it got listed, whether it not. And what it's done is it's squeezed the time of making that decision into under a second now, whether an investor will actually fund and buy that loan. And what's really attractive about that is that for traditional specialty lenders who have been balance sheet or use a securitization to actually fund their loans, they look at that process of pre-order, and it's a perfect match between the borrower and the investor, where they're not having to hold and take risk on that loan. For certain loans, it actually doesn't make sense for them to put it on their balance sheet. And so what's been interesting is the rise of Lending Club and Prosper. We're seeing now more and more inbound leads from more traditional specialty finance, and it's as big as companies as like GE, who are saying, how do we adopt this new business to meet our needs, and how do we take kind of whole loans to the next level, which is kind of an interesting evolution in the space that is really just now becoming a major trend.
Yeah, I mean, very, very exciting. So, Mike, do you want to kind of follow on with what you are seeing in terms of, Matt mentioned GE and equipment leasing, and I don't know if there's an announcement coming or not, but where does Zest play, say in that type of a relationship between, in working with the GE to sort of bring them into this world and maybe work better with an Orchard or a Crowdnetic?
Sure. So our Google-style math technology works, and it works in all across the entire credit spectrum. In the prime and subprime spaces, it is powerful to build better underwriting tools that better predict risk, so we can get pricing right and get people access to credit. In the super prime space, it is very powerful in targeting. So the super prime space is all about targeting whales, very few customers generating lots of profits. And so these technologies can sift through all the data and find out which are the prospects you should be chasing and which are the customers you should be booking. In terms of other spaces like factoring, equipment leasing, anywhere there is large amounts of data that can be brought to bear around a critical decision that can be modeled, these technologies are going to be powerful.
Great, thank you. All right, now to the equities guys. Scott, you awake?
Yes, ma'am. He is now.
Scott came all
Big
the way
data.
from Vegas. My good friend Scott. Scott is a master in compliance issues, and his company, FundAmerica, is very focused on those issues. But I think it would be great for you to talk to what you've seen in our industry, in our young industry so far, in terms of mistakes, challenges, and what you see as an expert as what the possible solutions are to make sure we don't kill ourselves before we're out the gate.
Yeah, I employ in our broker-dealer, I employ 2 former FINRA compliance examiners, and it looks like I'm about to employ a 3rd. So we have a lot of FINRA folks on staff. We take compliance very seriously, but we take doing it right very seriously. What we see happening in the embryonic stages of the 506 market, and people keep saying equity, it's securities, it's equity and debt. A lot of, especially young companies, it's always convertible debt, so very little equity, but some. Anyhow, whether it's equity or debt, any 506 offering or private offering, we see 2 problems. A lot of people getting into the space. You see a lot of real estate companies getting into the space, entertainment companies, other unregistered entities. Maybe they're creating SPVs and they're doing so under the investment advisor rules. But they don't have an appreciation for the fact that they're in the securities business. And even if they're not going to be registered, they still have to do things in compliance with SEC rules. And so you've got a pendulum of things where people are not in compliance at all and not thinking about it. They're trying to raise money, putting just a business plan up on the web, not complying with the Securities Act of '33 at all, the disclosure requirements. And then you have another pendulum of people where they get so terrified of the regulators that they go overboard on compliance. And the reality is there's a middle ground, and that's what they need to be seeking. The biggest thing that we see both of these things happening, but far more people are on the, oh, we're not regulated, we're not offering, we're doing 506C or 506B, we don't have to worry about regulations, and they don't think about it. And so really what the biggest hurdle right now for those of us in the securities industry is to ensure that these people get educated and ensure that their advisors, their professional advisors, their consultants, their lawyers, their accountants, the people they rely on, get educated as well, that no matter who you are, if you're playing in the securities industry, you are subject to securities rules. And then work with people like ourselves or CrowdClear or others, the people who are experts in doing this, and make sure that you're getting it right. And that's why we exist.
I guess I'll ask, and Steve or or Scott, feel free to answer, but how do you see technology and standardization playing into making us a more compliant, safer industry?
That, you want me to take the first crack at
Go
it?
ahead. It's all about technology.
So we think that standardization is kind of the key to making this whole thing work. You know, Scott spoke about compliance and how important it is. Also, want to second, you know, his sort of view of the world that there's, and I think there's quite a lot more people out on this end of the spectrum that, you know, wow, you know, this is great. It's just like Kickstarter. I don't need to worry about compliance. I can just sort of do whatever we want. And, you know, as the broker-dealer, we sit with our clients and we say, well, yeah, and that's kind of an interesting perspective, but, you know, if you sort of do that, we go to jail because we're the broker-dealer, and we've stayed out of jail for 20 years. We'd like to continue to do that. But in terms of making this whole thing work from an efficiency, from a technology, from a scalability perspective, standardization is really going to be important. In our very early days as a company, when we were working with a number of portal operators, all of whom in the end fell into that I don't understand security space, we would get every single document on every single deal in a completely different format. I mean, we tried to have a standard engagement letter, failed. We tried to have a standard form of offering memorandum, failed. We tried to have standard forms that people could use to present financials. None of this is required by law, but it puts an incredible burden on the person doing the compliance to have to learn a new language, almost as it were, every time a deal is presented. So if this industry is going to really succeed and create the kind of volume and that everybody sees as being possible, there needs to be standardization around the various different documents, so that, again, it's going to be a different offering memorandum each time, but I'm going to know that it's got these 5 sections. I don't need to learn how to speak French or German or Italian, because everybody's presenting data in a different way.
Yeah, both standardization and automation. Both. You've got to have the standardization element, and you've got to have the automation element. That's like with FundAmerica, we're divided into 2 companies. We have the broker-dealer, which is all the compliance and everything, and then we have this technologies company. We have FundAmerica Securities and FundAmerica Technologies. And FundAmerica Technologies is basically a Rails shop. So it creates the APIs and the applications so that then everything that has to be done from a standardization perspective is able to be just automated into the funding portal's front end. And by creating automated processes that are standardized, the whole market, the whole industry will be able to accelerate and do so in an efficient, cost-effective, and compliant manner.
We started out in the early days having to standardize a lot of the data. So we were looking at, when you're getting data feeds from all of these different, peer-to-peer lenders, they're all coming out differently. They all pull credit bureau from different places. And so trying to standardize and understand a portfolio when you're buying across 4 or 5 of them is very difficult. So we put in a lot of effort into do that and to standardize and to also create API docs that would then follow those standards. And that was kind of all, straightforward and transparent. What's been really interesting is after we've kind of started to finish that, now we've been pulled into everyone asking for us to help out on standardizing loan purchase agreements and the legal arrangements in order to make that, because that is where most of the friction is within the space today. And so it's interesting that that kind of standardization, trend is what really is needed to help kind of, expand the market, because, we're up to the point where billions of dollars are flowing through the pipes now every quarter, and it's just, I can't see us scaling up to 50 or 100 billion under the current system. I think it's just, there's too much friction in it, and so we have to focus on standardizing.
Yeah, there is no DTCC for the marketplace lending world. Everything is done, we're very, it's a very sexy world, but everything is done very manually. which is a whole nother panel and a whole nother business. But it's a good segue into talking about scalability because it applies to the crowdfinance industry as a whole. And I think, again, we're sort of victims of just rapid growth and maybe not enough of us with our experience in the space trying to solve these problems. Good for us, maybe not so good for the industry. But, Steve, do you want to talk about, given your background at E-Trade, sort of scalability with respect to 506 securities? You're right, Scott. And then we can kind of talk about that in the marketplace lending space as well.
Sure. Yeah, I mean, scalability is what got us into this industry in the first place. As Luan mentioned, myself and a number of my partners all had fairly deep senior experience at E-Trade. We became fascinated with the crowdfunding space, a lot of it having to do with this lady next to me in terms of getting us excited about the opportunity, but we couldn't find our place. We looked at a couple of different portal properties that we might buy. It didn't seem that was aligned with our skill set. But then when we started to think about what the rules, and by that I mean Title III rules that hopefully will come, what the rules meant was that previously where there might be an offering of $5-10 million that would be conducted over the phone, and an investment banker would call up 5 or 10 of his closest friends and get him to put $1 million in. With Title III, the ability to offer securities to unaccredited investors in very small dollar amounts, right? The rules mandate very small dollar amounts. So raising $1 million could literally be 500 people coming into that offering. We said, wow, this is going to be a business that's going to require scale. It's going to require straight-through processing. It's going to require the ability to take an investor from the moment they touch the platform to the moment they get the subscription document all the way through on an exception basis so that 90-95% of those guys swoosh all the way through. It's just going to take the ability to process orders of magnitude more transactions. So right now, our large focus has been on handling the investor onboarding process. If you think about a typical deal, there might be 100 deals. There could be 10,000 investors coming into those deals. So this is the larger end of the pyramid. We've got that just about nailed at this point. We're starting to move on to focus on how we can more automate the due diligence process, the review of the issuers. That's obviously always a manual process because we don't have computers reading subscription docs and saying, no, that's a bad clause, that can't be in there. So there's always got to be a certain amount of human intervention in there. But again, going back to standardization, to the extent we can get standard docs, we can get automated workflows that walk you through the process, it becomes a more scalable business model, and it allows us to help fuel what we all believe to be a very large industry.
Yeah. Anybody else have anything they want to add to that?
The conversation killer. Sorry.
It's okay. It's
It's easy to go down the rabbit hole of discussing exactly what it means to onboard a customer in a securities world or in a banking world or something like that, but let's keep some people in the room.
All right, so I'm going to ask one last question so we can get back on schedule. And if you know me, I'm very focused on cocktail hour always. So and I kind of have my friend Blaine McLaughlin talk about the secondary markets and liquidity issues. My one last question for you all gentlemen is one prediction, and it can be an idea from your own company or a product you're going to put out or someone you partnered with or whatever, but just one prediction on a technological or data innovation that's going to come out in the next year that will, when we're standing here next year on this podium, we can talk about and say, wow, that is so cool, it's so great that happened, we're a better industry because of it. And if you don't know any and you just have something that you'd like to see, then say it, and I'm sure somebody will pick it up and go raise a bunch of capital and go do it.
Where do you want to start?
I prepped you on this question. You didn't read all the way to the end of the email, did you?
Well, there's so many different things. I mean, for the lending world, what these guys are doing with big data and standardization of forms, I mean, it's unbelievable, and it's going to lead to hopefully some needed revolutions in the banking sector. But overall, to make this work, and I'll focus on crowdfunding, to make crowdfunding work, and by crowdfunding I don't mean just Title III, not even just Title II, I mean 506B, 506C, any form of
Title
raising
IV.
money via private exemptions to the Securities Act of 1933, blah, blah, blah. It takes an ecosystem. There's a lot of people involved in it. You've got the portal that has the front end, and they're working with issuers or they're working with investors, also known as the buy side and the sell side. But you have all kinds of folks under them. You have services that help verify the accreditation of investors, like verifyinvestor.com and others like that. You have services like ours that are providing escrow services or electronic document signature or things like that. You have services like CrowdCheck that are doing, helping with due diligence. You have what Crowdnetic is doing and creating aggregation models and and doing the research that's needed. You have all of these elements, and all of these things need to be built into the platforms, into the portals. So by the whole ecosystem of service providers being built into these portals, and we're going to see over the next 2 years an explosion in the number of portals out there. What we're seeing now with the real estate and other sectors is nothing. But the whole automation that has to come together to make a portal work, and all of the pieces that they need that users never are aware of, but that is needed, that is what, as it matures, as we all mature our products, it is going to make this entire industry fly. So that's really the revolution that I see coming.
So they need the black box. They need technology, compliance, broker-dealer, distribution, data, like any other normal financial services business.
Yeah.
Yeah.
Just
great.
to sort of.
I know you're going to copy him.
No, I'm not going to copy him. I'm actually.
Come on, Steve.
Good job, Scott.
I'm actually going to give you a huge, lead in to your next panelist, right? So the other thing that I think the industry needs, in which you're actually personally providing, right, is good market data, right? So we've talked all day long about secondary markets and their importance. We are also a firm believer of the importance in a secondary market to create a primary market. But in order for that market to happen, there needs to be market data, right? There needs to be the ability to price a security, because if you can't price it, you can't sell it, you can't trade it. So that's the thing that in my world we'd love to see.
Can't issue statements.
That's
Can't
us.
issue statements.
That's you.
Can't
And
carry
it wasn't even meant to be a softball to you. That's what I really think we need.
So I'll go a little bit of a different direction. Most of the conversations today are about how that kind of Lending Club and Prosper have kind of came out of nowhere. And I've been kind of paraded around the largest banks over the past month as they've realized that these companies are actually going public and are actually going to make a big splash. And if you look at the growth rates this year, and this is just the debt space, is predicted to be about $12 billion, and it's doubling every 9 months. And my prediction is actually that those growth rates are actually going to increase as it gains momentum, because not only are we seeing new sectors like real estate come on board and small business lending really start to ramp up, but we're also seeing, again, a lot of the traditional specialty finance originators start to say, this is a better model for funding my loans than what existed before. And so I really think that this could be the very, very beginning of a massive change in the way that loans are funded and distributed.
Thanks,
Now,
Matt.
I would just say, in order to drive the kind of customer acquisition growth that's going to be required to support the valuations that Lending Club and Prosper are fetching, there will need to be serious innovation on the consumer product side. And the key to innovating on the product side is developing better credit decisioning tools, better underwriting models that will allow the lenders who use those tools and have access to those tools the opportunity to innovate to make sure we get the right product to the right customer at the right time. So I think, I'm really curious about the innovation on the consumer side and how innovators are going to proliferate sort of the kinds of products that are made available to the consumers through the crowd funding model.
And looking at the technology side, one thing that I haven't really heard today is the use and the role of the mobile. So we are seeing that today, almost like a year back, 25% of our customers used to come through mobile, and today it's more than 50%. And we have made it so easy for customers to actually complete everything on their mobile. So I think we are seeing that explosion and that growth. And that's also good from a risk and a big data perspective. Actually, you can do a lot more on that. On the side, I agree with Matt, is, the banks are still slow. The banks are looking at it. But I think banks have one advantage, which is that they're very low rate of capital because they can take deposits. I think the big revolution or the second phase of the revolution will come when marketplaces can start raising non-insured deposits. That's starting to happen in China. So a company did an IPO here, I don't need to take the name. And, they built a $20 billion SME lending business in 3 years. And they got a banking license in China to start taking non-insured deposits where they are paying 200 bips extra than banks, and they're killing banks because now they have the low-cost deposits and they have the borrowers on their own platform. So as that starts happening, and I think that could totally change the whole banking industry in the country.
Yeah.
Actually.
Amen, Rohit. All right. Well, thank you. Thank you guys very much. Hopefully you enjoyed that panel.